So I'm Andrew Whitworth. I'm Policy Director for EMEA for Ripple. Ripple is a B2B blockchain tech service company. We work mainly in the cross-border payment space. A lot of work both with private and public forms of digital money. I'm also the chair of the Blockchain for Europe Association based in Brussels. So we have a lot of these similar conversations in the European context as well.
I'm Keneze Giocoli, co-founder and co-CEO of Millicent Labs. We're a blockchain-enabled fintech company building infrastructure for tokenized fiat money. I'm also currently sitting on the Bank of England's CBDC Technology Forum.
So to get started on this, Andy, to start at the very beginning, what is money? And what's the difference between the money we have today and what the Bank of England refers to as new forms of digital money?
Yeah, well, thanks. I've not this question. What is money? 5,000 years or so. Hopefully the same answer, at least if you believe The Economist, which I do. So, I mean, famously, I think, and maybe in the room know, money has three functions. It's a store of value, it's a means of exchange, and it's a unit of account. At different times, people focus more on one part of this or the other. But traditionally, something needs to have all three of these functions traditionally, well, again, it's very different. Traditionally, something needs to have all three forms of this, all three functions of this to count as money. Well, that's gone through the back. To count as money. I think when it comes to the debates we're all having today, we've seen how this has played out, with people focusing one part more than the other. So, you know, when talking about stablecoins, is often thought about as a means of payment, but also often thought about as a unit of account, a store of value. What I think is quite interesting, and obviously, you know, Bitcoin people talk about this all the time. What I think is quite interesting is this unit of account function, because we often forget about it. And the more I think about it, the more this is where the sort of relevant definition of money comes from. So if you think about it, when you're paying for something, particularly in the modern world with fiat, where it's not linked to gold or it's not linked to anything else, of course, we all know you're just paying with something that other people have accepted they will accept on behalf of something, because it has a certain nominal value. And obviously, you know, we're all well aware of what's going on with inflation in various countries and things like that, where the nominal value can separate out from the value of the goods underneath, and you end up with different prices, things like that. Now, what I think is interesting when it comes to the idea of digital money, these future forms of money you're talking about, is that what we're seeing is different types of this, be it crypto asset, be it stable coin, be it tokenized deposit or CBDC, targets different functions of the traditional uses of money. Where I think we're at now compared to where we were whenever it was, 10, 12 years ago, when this whole sector first started, is I think the question of unit of account has been settled definitively, and settled definitively in favor of fiat definitions of money. If you think of somebody, you know, in the days when these existed, called a Bitcoin billionaire, that didn't mean they had $1 billion Bitcoin. It means they had $1 billion worth of Bitcoin or pounds or whatever. Similarly, stablecoins, when you think of Libra as the first one to come along, that was going to be backed originally by a basket of currencies, and was going to be worth one Libra, that was, you know, whatever it was worth around the world. Now stablecoins are very much backed by a single currency. They don't have to be, but they are, or they do tend to be, although you can very well correct me if I'm wrong. And in a sense, they are piggybacking off the unit of account function of a fiat currency. So I think what we're now talking about when we talk about different digital forms of money and their interaction with the traditional financial sector is where does the technology that we have, blockchain usually, where does that help for the different functions, the store of value or the means of exchange? And I think what we're seeing is these different types, as I say, CBDC, crypto assets, stablecoin, tokenized deposit, they have different benefits, different costs, different trade-offs. Some of these, in a sense, are operating in a different financial world compared to traditional financial fiat monies. And what we need is an on or off ramp between the fiat world and the digital asset world, digital money world. Some of them are replicating the fiat world on, or trying to replicate the fiat world on chain. I think that's where I'd place stablecoin, where I'd place CBDCs, maybe tokenized deposits too. So they have different functions, different benefits, different costs, different trade-offs. When it comes to looking to the future, to me, what matters, therefore, is the transparency to understand what are the different characteristics of these different forms of digital money. The education, so people get it, so they know what they're getting, they understand what that means. And then the interoperability between them. So can you move between one or the other? Now, there is a bit of a debate about whether that needs to be total free interoperability at all times. I tend to think it does. You could say, well, actually, if you know that a bank deposit is stickier than cash in your wallet, and everyone theoretically does know that, actually, does it matter, if a digital form of money has different characteristics, they're not perfectly always interoperable or convertible, frictionless between one and the other. As I say, I think what matters is that they can ultimately be exchanged for each other, that people know what they're getting and they understand what the trade-offs of these things are. Ultimately, I see, certainly Ripple, my company, sees that in the future there will be a mix of different types of money, physical, digital, private, and public. And really what matters is that the firms in this space work together to create a space where consumers or end users, whatever they may be, understand what they're getting and know how to move between this in a coherent way.
Thank you. And you touched on a few interesting points there. First of all, you've begun alluding to the difference between public and private money and the different roles that these different kind of types of issuance can play. Kene, would you like to expand a little bit more on public versus private money, what that landscape looks like today and what that landscape might look like in the future with new forms of digital money?
Sure. So you can think of money as being a claim against an institution, whether that's a public or a private institution. It's a liability of that institution. And so you deposit your £100 at the bank, and that bank now owes you £100. What they do with your money in the interim is not really of your concern, so long as you can take back the £100. At least that's the argument that they make. Now, the central bank is the lender of last resort, or is the creator of money, is the public sector side that creates that unit of account, store of value, medium of exchange, etc. And according to the prevalent thinking from the BIS and many of the central banks, it is that publicly issued money that's the glue that holds together the other forms of money in the system. Because a bank deposit is not the same as e-money, but even more so, a bank deposit from Lloyd's technically isn't the same as a bank deposit from Barclays, because one is a claim on Lloyd's, one is a claim on Barclays. And whether we know it or not, somewhere in the back of your head, you know that you can take your card and go to the ATM and withdraw £100 in central bank money, in risk-free public money. And that is what, to Andy's point about the convertibility of money, holds the entire system together.